I want to talk to you guys about security investing. And that's the topic a lot of people are terrified about because they think it's like rolling the dice in Atlantic City. And it's really simple if you know exactly what you're doing. Problem is most people don't have a clue what they're doing. And so they think securities investing is following the Wall Street Journal every day and investing in things that they see on television. And securities investing can be as simple as investing in mutual funds and tax-deferred annuities, but not the way that everybody's accustomed to doing it. Usually when you start a job, somebody says, hey, invest in the tax-deferred annuity or the IRA that the job has, the 401k that the job has just through your union. Or you go to a financial planner and the financial planner will sit you down and ask you about your risk tolerance and say, well, based upon your risk tolerance, you should invest in these 5 to 10 different mutual funds. Red flags should go up anytime you hear something like that because first of all, you're listening to people who don't really have anything. So if you're listening to somebody on the job, they have a job. And if you're trying to make a lot of money, you can't really listen to somebody who has a job. So red flag again when you're talking about a financial planner. Financial planner doesn't get paid by you. Financial planner gets paid by the fund companies. So if the financial planner gets paid by the fund companies, are they giving you the best funds for you or the best funds for them? There are over 6,000 different mutual funds, but they only present 5 to 10 to you. And so the 5 to 10 funds that they present to you are funds that the fund companies are trying to push because they're the worst performing funds. The absolute worst performing funds are funds that the union presents to you, and the fund companies push them to the unions because they know no one will question them. So if you check your IRA, 401k, TDA, you'll see that it's performing terribly. If you check the mutual fund that you got from a financial planner, you'll see that it's performing terribly. And when I say terribly, we have to understand the type of return on investment that's required in order to thrive, in order to make a significant payoff. The average person is in the 35% federal tax range. And you have to compare your federal tax and you have to compare it with the current inflation rate. The current inflation rate is about 3.6%, so we'll round that off to 4. If you're in the 4% inflation rate and you're in the 35% federal tax range, in order to break even on your money, you have to get at least a 6.2% return on investment. That's for your money to stay the same over a period of time. So in order to get a good return, obviously we have to get greater than that, and you should never invest in anything that gives you less than a 10% return. But what you would like to do is find something that gives you a 20% return or more. I always tell people you need 20% return on investment, and they say, well, Heru, you're crazy. Where can I find something that pays 20% return on investment? And I say it's simple. If you have access to a computer, you can do it in 10 minutes. And I'm going to share a secret with you guys that was shared with me by one of the wealthiest people in America. And it took me about 10 minutes to figure it out. And so I'm sure it'll take you about 10 minutes to figure out as well. He said, go to morningstar.com. He said, www.morningstar.com. And he said, don't subscribe to anything, don't pay anything, don't buy anything. Well, you can't actually trade on Morningstar. Morningstar tells you the performance, how well things are performing, stocks, bonds, mutual funds. And click on the Morningstar tools and then go to Mutual Fund Quick Rank. Now, when you go there, it's going to show you, it's going to ask you how you want to see it. You want to see year to date, 1 year annualized, 5 year, 10 year annualized. And if you want to amuse yourself, then you go to 1 year annualized and you'll see that there are mutual funds that are in the 80s, 90s, and maybe even 100% return on investment. Now, the amateur would jump right at it. 100% return on investment, throw all their money in there, and probably will lose it. Because a mutual fund that just started this year really has no history. Means that you really can't trust its performance. What you want to do is you want to go to 10-year annualized. 10-year annualized means that this mutual fund has a 10-year performance history, that it's gone through the ups and downs, the fluctuations that the stock market has gone through, and this is the return on investment over that 10-year period. You'll see that the top performing funds on 10-year annualized are 23, 24, 20% return on investment over a 10-year span, which is phenomenal. And the thing is, most of these investments take as little as $1,000 to get in. Now, everybody has $1,000. If you don't have $1,000, borrow $1,000. Use your credit card. As long as the interest rate is lower than what it pays, That's the best way to do it. So anybody here can find a well-performing fund in 10 simple minutes. If you don't have a computer, go to the library. So anybody can do it.